Welcome back to Talk Tickers. This is the show for the experienced investor, where we strip out all that corporate fluff and get straight to the raw earnings data that actually moves the market.
Right, because nobody needs another summary of a CEO's opening remarks. You need to know what's actually under the hood.
Exactly. And today, we're doing a deep dive into Omnicom Group. The ticker is OMC.
This is a huge one.
It is. I mean, we are finally getting our very first quarterly look at the beast created by the Omnicom and Interpublic Group merger, that IPG deal.
Which closed right before Thanksgiving in 2025. So the market has basically been waiting with bated breath to see the actual integration roadmap.
Yeah, the market verdict is officially in on this new Omnicom debut, and the verdict is emphatically bullish.
Emphatic is the word.
The stock ripped up 13.3% the day after the print. I mean, 13.3% for a legacy ad holding company.
On incredibly heavy volume, too.
Right. And what's wild is that the market looked completely past a truly messy JEP miss. I mean, they fell in love with the capital return and these crazy synergy upgrades.
They absolutely did.
So our mission for this deep dive is to hit those headline numbers, dissect the portfolio surgery that management is performing right now, and analyze these doubled synergy targets.
We also need to get into the AI platform positioning, which is a major part of the thesis here.
We will definitely get into that. And for everyone listening, make sure you stick around to the end, because we'll wrap up with our This Is Not Financial Advice segment, where we've got a trade idea that plays directly on all this volatility.
A trade idea that leans heavily into the financial engineering going on here.
Yeah. So let's jump straight into the results snapshot. Top line revenue came in hot, $5.53 billion.
Beating the consensus of $5.04 billion.
Exactly. So that's nearly a 28% year-over-year jump.
Right, but you have to keep in mind that is driven primarily by layering in that IPG revenue. It's an inorganic bump.
Right, it's the merger math. But then we look at the bottom line, and this is the messy part.
The kitchen sink part.
Yeah. GAAP EPS was a deep loss, negative $4.02 per share.
A massive red number on the screen.
And even if you look at the non-GAAP EPS, which strips out some of that noise, it came in at $2.59.
Which was actually a miss. Consensus estimates were sitting around $2.68 to $2.72.
So here is the disconnect for you listening at home. Why on earth did the stock rally 13% on an earnings miss?
Because that $4.02 loss was entirely manufactured by management aggressively clearing the decks.
They took a $1.12 billion charge, right?
Right, $1.12 billion in severance and repositioning costs. They are front-loading all the pain into this first partial quarter.
So you take the hit immediately.
Exactly. The market ignored the EPS miss because the forward-looking guidance on cash flow and the synergies was just incredibly strong.
They essentially said, we are taking out the trash today, so tomorrow looks pristine.
That's classic merger execution.
And before we move off the top line, we need to talk about their organic growth number, because they calculated organic growth at 4% for the quarter.
But that 4% comes with a massive asterisk.
A huge asterisk regarding how they're classifying what they call disposition assets, which we are going to unpack in a minute because it changes the whole growth story.
It's pure portfolio surgery.
Okay, let's pivot into the deep dive on the cost side first, because I think this is what actually drove the 13% pop. The $1.5 billion synergy shock.
This was the jaw dropper of the call.
When the deal was first announced, the synergies were pegged at $750 million. Standard, believable merger savings.
Like, the street modeled that in immediately.
But on this call, CEO John Wren and CFO Phil Angelastro came out and literally doubled that number, $1.5 billion over 30 months.
They doubled the target and they accelerated the timeline. They aren't waiting around.
No, they said they expect $900 million of those savings to hit the P&L in 2026 alone.
That is aggressive. That is management looking at the IPG organization and finding way more bloat than anyone thought existed.
So let's break down where these cuts are actually coming from. The bulk of it, $1 billion, is labor.
$1 billion in just labor. That's thousands of jobs.
They are eliminating duplicative corporate roles, streamlining regional brand structures.
Well, you don't need 2 global HR departments, 2 global legal teams, 2 public company compliance divisions.
And there's a heavy push toward offshoring and outsourcing here, isn't there?
Absolutely. They are pushing the execution level work to lower-cost geographies.
Then you have real estate cuts making up $240 million.
Which makes perfect sense. You've got two giants that are now one. You consolidate the offices.
You put McCann and BBDO in the same building.
Exactly. You stop paying double rent in premium markets like London and New York.
And the final bucket is operations and IT coming in at $260 million.
Procurement, shared services, standardizing the tech stack.
So when you analyze this level of cost cutting, it really signals a structural shift, doesn't it?
It does. It signals a move away from the traditional holding company model.
Where each agency operates like its own little fiefdom.
Right. They're moving to a unified operating model. They are aggressively removing all those duplicate public company costs of IPG.
They are trying to run this like an integrated corporation, not a portfolio of independent ad shops.
Which is a necessary evolution if you want to protect your margins in this environment.
Now, speaking of the portfolio, let's get into the dispose and exit strategy. Management is actively culling the herd.
They are doing some serious portfolio surgery.
They have identified $2.5 billion in annual revenue that they are labeling as either non-strategic or just underperforming.
$2.5 billion, that's a massive chunk of revenue to just decide to walk away from.
But they're already executing on it. They've sold or exited $800 million worth of this revenue already.
Including selling off Jack Morton, the experiential business.
Right. And they plan to clear the rest of that $2.5 billion within 12 months.
And that's not even counting the minority stake shifts.
Right. Explain that part for the listeners, because that's another $700 million in revenue being restructured.
Yeah. So for smaller markets, instead of outright selling, they are converting from majority ownership down to minority stakes.
So they might drop from owning 60% to owning 40% of an agency in an emerging market.
Exactly. And the reason you do that is to reduce all the compliance and regulatory headaches of majority ownership.
But you still keep the client service footprint in that region.
You keep the footprint, you keep the capability, but you get the friction off your balance sheet.
And this brings us back to that organic growth math we mentioned earlier, the 4%.
Right. CFO Angela Astro noted that if you exclude this entire disposition group,
The stuff they are selling or minimizing.
yes. If you exclude that, because it had lower margins and lower growth anyway, the core retained portfolio grew at 4%.
It's classic financial engineering.
It really is.
By stripping out the slow growth assets, the remaining company immediately looks faster and leaner to the street.
And the market bought the narrative. They are rewarding the future state of the company, not the messy present.
Okay, let's talk about how they are rewarding the shareholders directly.
The capital allocation bazooka, as I've been calling it.
It really is a bazooka.
The board authorized a $5 billion share repurchase program. $5 billion.
That is a massive percentage of their market cap.
And they aren't just dripping this out over 5 years. They launched a $2.5 billion accelerated share repurchase immediately.
The ASR.
Right. So for you listening, an ASR means they go to an investment bank, hand over $2.5 billion in cash, and retire a massive chunk of shares right now, today.
Which acts as a huge floor under the stock price.
But we do need to look at the other side of the balance sheet, the debt and leverage. Yeah, because they assumed $3 billion in IPG debt in the merger.
Plus, they are refinancing a $1.4 billion bond that's due this April.
And interest rates aren't exactly where they were 5 years ago.
No, they are not. So net interest expense is going to jump by $210 million in 2026.
That's a real hit to the cash flow.
But management pointed out that the leverage ratio remains manageable at 2.4 times.
2.4 is totally fine for a company throwing off this much cash.
So what is the market signal here? Why the aggressive ASR while you're digesting $3 billion in new debt?
The signal is management screaming at investors, we believe our synergy targets are real.
They know the cash flow is coming.
Exactly. They are shrinking the float before the earnings power of this combined company is fully realized by the broader market.
They want to buy their own stock while it's still cheap relative to what they know the 2026 earnings will be.
It's a very confident move. You don't execute a $2.5 billion ASR if you are worried about integration hell.
Okay, let's shift gears to the structural changes. They are pushing this connected capabilities narrative and a major pivot into AI.
This is where they try to prove they aren't just a dinosaur ad agency anymore.
Right, they are moving away from those independent agency silos we talked about. Media is now over 50% of the total business.
Media buying is where the scale actually matters.
And to support that scale, they are launching what they call the next generation Omni platform.
Which is essentially a massive tech stack integration.
Yeah, they are integrating the legacy Omni data with IPG's Interact platform.
Plus, they have Axiom for data identity, which is crucial.
And Flywheel, their commerce cloud asset.
Right. So you put Omni, Interact, Axiom, and Flywheel together, and you have a closed-loop data ecosystem.
And they spent a lot of time on the call talking about Gen AI. But it wasn't just the usual buzzwords. The reality check here was fascinating.
Yeah, the discussion actually moved past just using AI for efficiency and focused on output.
Right. John Wren gave this great example. In the old days, creative teams would pitch 2 or 3 concepts to a client.
Because humans can only storyboard so fast.
Exactly. But now, with agentic AI workflows, they are testing 20 to 50 concepts synthetically.
Before they ever spend a single media dollar.
They generate the variations, test them against synthetic audiences, and only produce the winners.
And the key quote context here is really important. Wren emphasized that eventually everyone is going to have the same base AI tools.
Right. The large language models get commoditized.
Exactly. So if everyone has the same AI, what is the differentiator?
It's the intellectual capital and the data scale.
And Omnicom is betting that their sheer scale, combining all that IPG and OMC proprietary data, is what wins the arms race.
That brings us to the broader investor context. If you look at the sector landscape, these ad agencies are fighting a two-front war right now.
It's brutal out there.
On one side, you have intense client scrutiny on ROI. Clients want measurable results for every dollar.
And on the other side, you have direct competition from the big tech platforms themselves.
Meta and Google.
Right. Meta and Google are going straight to the brands and saying, just use our automated AI ad tools. You don't even need an agency.
So to survive that, Omnicom is pushing this platform narrative. They are trying to re-rate the stock.
They want to move from being valued at a low multiple service agency to a higher multiple tech-enabled platform.
And that Omni plus Axiom plus Flywheel stack is their core argument for why they deserve that multiple expansion.
But the street still needs to see the proof.
Which is why forward guidance was the elephant in the room on this call.
Yeah, there was no formal 2026 guidance given.
Which is usually a massive red flag for a Q4 earnings call.
Highly unusual. But the market gave them a pass because of the merger timing. You can't close a deal this big in late November and have perfect 2026 guidance ready in February.
So what is the catalyst we need to watch?
All eyes are on Investor Day, March 12th.
March 12th. Mark your calendars if you're trading this.
That is when management has promised to unveil the granular profit plans, the actual nuts and bolts of the margin expansion.
And the sentiment takeaway here is that the lack of guidance didn't hurt the stock today solely because that huge buyback and those double synergy targets filled the void.
It bought them time until March 12th.
Okay, let's get into the fun part of the deep dive. The "This is not financial advice" segment.
The trade idea.
Exactly. So for you listening, remember, we're just talking theory here. We don't know your risk profile. This is for entertainment. Do your own due diligence. Nothing here is an offer to buy or sell securities.
Standard disclaimer applies.
All right, here is the setup. We have a company undergoing a massive restructuring.
A historic restructuring.
We have a defined catalyst date coming up on March 12th.
And we have a management team aggressively buying their own stock right now.
Right. So my pitch for this is a strategy I'm calling the pre-event synergy squeeze.
I like the name. How does it work?
It's a call spread strategy. The logic is that the market has obviously priced in the headline $1.5 billion synergy number. The 13% pop proves that.
Right, it's baked in.
But I don't think the market has priced in the speed of the realization or the specific margin expansion details that are going to be dropped on Investor Day.
The street analysts haven't updated their models for the new unified operating margin.
Exactly. And with that $2.5 billion ASR executing, literally right now, there is a literal floor under the stock.
Corporate buying pressure is relentless.
So the trade is to look at the April monthly options chain.
Because that captures the March 12th event safely.
Right. You buy the at-the-money calls to get your delta exposure.
But those are going to be expensive right now because volatility is elevated post-earnings.
Which is why you finance the purchase by selling out-of-the-money calls against them. Look at strikes about 15% higher.
So a standard bull call spread.
Yeah. The rationale is that you are betting the investor day reveals a new Omnicom margin profile that is significantly higher than current street models.
Which would force a violent repricing upward from the analysts.
Right, you get the squeeze, while the ASR basically prevents the stock from crashing if the broader market gets weak.
Now, what is the risk here? Because there is always a risk.
A risk is integration hell.
Which is a very real possibility when you mash two huge ad networks together.
If they get on stage on March 12th and have to admit that the cultures are clashing, or worse, that major clients are leaving because of account conflict,
then the premium evaporates immediately.
Yeah, if the revenue churn outpaces the cost savings, the trade is dead.
But mathematically, the risk-reward really favors the financial engineering upside right now.
It does. The downside is heavily cushioned by the buyback.
It's a smart setup.
So let's recap everything we've covered today. Omnicom delivered what looked like a really messy quarter on paper.
A $4 loss is ugly.
But it was actually a masterclass in merger execution.
They beat on revenue, they doubled the synergies to $1.5 billion, and they unleashed $5 billion in buybacks.
So the final thought I want to leave you with is this. The traditional holding company dinosaur in the ad world is dead.
It's completely obsolete.
Omnicom is actively trying to birth an operating system for marketing.
A unified, data-driven, tech-enabled platform.
And that 13% move suggests the market actually believes they can pull it off.
It's a huge vote of confidence from institutional capital.
So keep your eyes glued to that March 12th Investor Day. Until then, watch the tape. This has been Talk Tickers.
Thanks for joining us on this deep dive.
Remember to do your own research, and we'll see you on the next one.